In the fast-paced world of global finance, a single question is keeping Wall Street awake at night. Are we currently living through the greatest technological revolution in human history? Or are we inflating a trillion-dollar bubble that is about to burst? The parallel is hard to ignore, drawing our minds back to the peak of the dot-com boom in March of the year 2000. Back then, internet stocks soared to heights that defied all logic, as investors threw caution to the wind. Fast forward to today, and the market capitalization of AI-focused companies is expanding at an unprecedented rate. At the absolute center of this storm stands one giant, Nvidia. Just as Cisco Systems was the undisputed king of the dot-com era, Nvidia has become the king of the AI age. Both companies are what Wall Street calls shovel sellers in a gold rush. Cisco sold the routers and switches that built the physical infrastructure of the internet. Nvidia sells the graphics processing units, or GPU, that power the neural networks of artificial intelligence. But as the year 2000 progressed, Cisco's fairy tale came to a sudden, painful end. When the telecommunications bubble burst, Cisco lost nearly 90% of its value, a crash from which the stock took decades to recover. So the million-dollar question is Nvidia destined to repeat Cisco's tragic fate? To find the answer, we have to look past the hype and look directly at the hard financial numbers. And the numbers tell a story that is very different from the year 2000. At its peak, Cisco traded at a price-to-earnings ratio of over 130 times. Nvidia, despite its massive price run-up, trades at a far more reasonable valuation of around 40 to 50 times forward earnings. But the biggest difference lies in the profit margins. Cisco's profit margins never crossed 15%, even at the absolute peak of the internet boom. Nvidia boasts a net profit margin exceeding 50%, a number almost unheard of for a hardware manufacturer. This means Nvidia is generating massive, tangible piles of cash, while dot-com companies were mostly fueled by speculation and debt. However, the bears warn that we are not out of the woods yet. A major concern is the extreme concentration of the stock market index. Just like in March of the year 2000, a tiny handful of mega-cap tech giants is carrying the entire stock market on their backs. If one of these pillars cracks, the entire house of cards could come tumbling down. The second danger is the capital expenditure cycle of Nvidia's customers. Tech giants like Microsoft, Google, and Meta are spending tens of billions of dollars every quarter on AI infrastructure. They are doing this out of fear of missing out, rather than immediate profitability. But what happens if the actual commercial utility of artificial intelligence fails to justify these massive investments? If these tech giants slow down their chip buying even by 10%, Nvidia's growth narrative could stall instantly. This is exactly what happened to Cisco. The builders finished the network and then the buying stopped. So, how should a wise investor navigate this high-stakes financial landscape? First, remember the rules of value investing. Price is what you pay, value is what you get. Avoid chasing hype and focus on companies that have strong balance sheets, high free cash flow, and actual customer utility. In the end, technological revolutions are real, but market cycles are undefeated. If you want to protect your wealth, focus on the facts, ignore the noise, and let time work its magic.